Today, where is the Fed put? The Fed put now. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the S&P 500 closed higher on Wednesday, led by tech, as investors assess the Fed's plan to raise rates 7 times this year after the central bank delivered its first hike in more than 3 years. The Federal Reserve on Wednesday approved its first interest rate increase in more than 3 years, an incremental salvo to address spiralling inflation without torpedoing economic growth. Taken together, the inflation, growth and rate forecasts imply material upside inflation risks are on the minds of the committee members, driven by a structural change in inflation and wage dynamics versus that seen pre-pandemic, when both were persistently below expectations. The most lucrative concept to believe in over the last 30 years was in what the market commentators called the Fed put. It meant that after any equity market sell-off, it's only a matter of time before the US Federal Reserve comes to the rescue by easing financial conditions. It always has the back of the share market, so the right strategy has been to hold or buy more in the belief that the monetary cavalry will save the day. And now the prevailing wisdom is that the Fed put has either expired, or to use options parlance, the strike price has changed. Translated, that means the Fed won't step in to save the market, or perhaps not until a much sharper drawdown has occurred. The message now is that monetary policy has to be tightened to bring inflation down towards the 2% target. That is the concern, not economic growth nor the labour market, which is historically tight, and not asset prices, which are still elevated. The politics of monetary policy have also changed. For the last decade, central bankers have eased conditions, fostering enormous increases in asset prices for marginal increases in jobs. They argued that without inflation, the trade-off of income inequality had been worth it. But now living costs are rising at a faster pace than wages increase, and the subject of inflation, not inequality, is entering the political discourse. My question is this: what if the market drops another 30%? Would the Fed then not reverse course again? That has to be now the really important big question, which is this: where has the Fed put the Fed put? But as UBS equity strategist Francois Trathan wrote back in the pre-COVID world of 2019, in the past 20 years, the so-called Fed put has failed to revive equities the way rate cuts did in the 1990s. The 2 easing cycles of this millennium took place amidst severe declines in equities. Now, after keeping its benchmark interest rate anchored near zero since the beginning of the COVID pandemic, the policy-making Fed Open Market Committee said it will raise rates by 0.25 percentage points or 25 basis points.
I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
That will bring the rate now to a range of 0.25 to 0.5%. The move will correspond with a hike in the prime rate and immediately send financing costs higher for many forms of consumer borrowing and credit. Fed officials indicated the rate increases will come with slower economic growth this year. The rate rise was approved with only one dissident, That was the St. Louis Fed President James Bullard, who wanted a 50 basis point increase. Now, the committee last raised rates back in December 2018, then had to backtrack the following July, thanks to market pressures, and began cutting. And in its post-meeting statement, the FOMC said it also anticipates that ongoing increases in the target range will be appropriate.
As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
And addressing the Fed's nearly $9 trillion balance sheet, made up mainly of treasuries and mortgage-backed securities it has purchased over the years, the statement said, in addition, the committee expects to begin reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities at the coming meeting. Fed Chairman Jerome Powell, at this post-meeting news conference, hinted that the balance sheet reduction could start in May and said the process could be the equivalent of another rate hike this year. The indication of around 175 basis points in rate increases this year was a close call. The dot plot of individual members' projections showed 8 members expecting more than 7 hikes, while 10 thought that 7 total in 2022 would be sufficient. We are attentive to the risks of further upside pressure on inflation and inflation expectations, Powell said at the news conference. The committee is determined to take the measures necessary to restore price stability. The US economy is very strong and well positioned to handle tighter monetary policy.
Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside.
Committee members bumped up their inflation estimates, expecting the personal consumption expenditures price index, excluding food and energy, to reflect 4.1% growth this year, compared with the 2.7% projection in December 2021. And core PCE is expected to be 2.7% and 2.3% respectively in the next 2 years, before settling to 2% over the longer term. Good luck with that. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices and broader price pressures, the statement said. Officials also adjusted their economic outlook on multiple fronts, seeing much higher inflation than they expected in December and considerably slower GDP growth.
The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024.
On the GDP side, December's 4% was sliced to 2.8% as the committee particularly noted the potential implications of the Ukraine war. Subsequent years, though, were unchanged. The committee still expects the unemployment rate to end this year at 3.5%.
The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year, and remaining near that level thereafter.
The invasion of Ukraine by Russia is causing tremendous human and economic hardship, the statement said. The implications for the US economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. Stocks initially reacted negatively to the announcement, but then bounced back. Bond yields briefly moved higher, with the benchmark 10-year Treasury rising to 2.22% before receding. Ultimately, they've come through with a clear message that the Fed has a path forward to continue to tighten in response to this overwhelming concern about inflation, said Jim Baird, Chief Investment Officer at Plant Moran Financial Advisors. The question is, will it be enough? And have they even recognized that they have perhaps fallen behind the curve? The central bank had slashed its federal funds rate in the early days of the pandemic to combat a shutdown that crippled the US economy and financial markets while sending 22 million Americans to the unemployment line. But myriad factors have combined to force the Fed's hand on inflation, a condition that policymakers last year dismissed as transitory before capitulating. Officials over the past 2 months have strongly indicated that interest rate hikes are coming, with the main question left for investors being how many increases and how quickly they would come. The current trend of price increases at their fastest 12-month pace in 40 years has been fed by demand that has far outstripped supply chains that remain clogged, if less so than their pre-pandemic eras. Unprecedented levels of fiscal and monetary stimulus, that's more than $10 trillion worth, have coincided with the inflation surge, and the Ukraine war has coincided with a major spike in oil prices, though that has abated in recent days. Heading into this week's FOMC meeting, markets have been pricing in the equivalent of about 7 0.25% hikes this year. However, traders were split 50-50 over whether the Fed might hike 50 basis points in May, as some officials have indicated could happen if inflation pressures persist. Prices are up 7.9% year over year, according to the Consumer Price Index, which measures a wide-ranging basket of goods and services, and energy has been the biggest burden as gasoline prices have risen 38% in the 12-month period. But price pressures have broadened out from simply gas and groceries. Clothing prices, after plummeting in the early days of the pandemic, have risen 6.6% over the past year. Motor vehicle repair costs are up 6.3%, and airline fares just jumped 12.7%. Rent of shelter costs, which makes up nearly 1/3 of the CPI, has been moving up sharply in the recent months and is up 4.8% over the year. All of these cost increases have left the Fed's 2% target inflation in the dust. The Fed in September 2020 approved a new approach to inflation in which you could let it run hotter in the interest of a full, most notably inclusive employment goal that spans across race, gender and wealth. However, the change in approach was followed almost immediately by more pernicious inflation than the US economy had seen since the days of the Arab oil embargo, an inflation that peaked in the early 80s at nearly 15%. In those days, the Paul Volcker-led Fed had to jack up interest rates to a point where they tipped the economy into recession, something central bankers now want to avoid. Back then, the Fed funds rate eclipsed 19%. Baird said that the Fed will need to live up to its promise to be nimble if it is to continue to assuage market fears about runaway inflation. Will the path that they've laid out be enough to bring inflation back down to more comfortable levels in some reasonable time frame? The possibility certainly exists that they could get more aggressive, he said. And Federal Reserve officials expect to hike rates roughly 6 additional times this year, bringing its benchmark interest rate to nearly 2%. The median member of the Federal Open Market Committee expects the Fed funds rate to be 1.9% at the end of this year, according to the release. And on Wednesday, the central bank raised its rate to between 25 and 50 basis points. Just remember, a basis point is equal to 0.01%. But it's worth noting that there are some big gaps amongst the individual projections, with one member seeing rates near 1.5% at the end of the year, while another sees the rate crossing 3%. The central bank also sees the Fed fund rate rising to 2.8% in 2023. The Fed's latest projections show rate hikes to near 2% in 2022. The committee seeks to achieve maximum employment inflation at the rate of 2% over the long run. With appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labour market to remain strong, the central bank said in its policy statement. The committee's previous projections, released following a meeting in mid-December, showed the majority of members expected 3 total hikes in 2022. That would have brought the Fed funds rate to somewhere between 75 and 100 basis points. Just 2 committee members projected the rate to rise above 1% this year. However, market expectations moved towards more hikes in recent months as inflation has remained high and central bankers have signalled a more aggressive stance. And as at midday on Wednesday, markets implied 7 25 basis point hikes by the end of the year as the most likely outcome. While the Fed is sticking to 25 basis point hikes, it could choose to go up 50 basis points or more in one step. And the committee members also raised their expectations for inflation, with PCE inflation projections now to come in at 4.3% in 2022, 2.7% in 2023 and 2.3% in 2024. Bear in mind, the committee previously projected 2.6% in 2022, 2.3% in 2023 and 2.1% in 2024. So have you any more confidence in the latest reprojections, I ask? Chairman Jerome Powell said during his press conference on Wednesday that participants continue to see risks as weighted to the upside on inflation. And the Fed also cut economic growth expectations, forecasting 2.8% GDP growth in 2022. In December, the committee's median projections called for 4% economic growth in 2022. We had expected the dots to reflect 5 hikes in 2022 and 5 more in 2023, but instead they reflect a much steeper and higher trajectory for the funds rate than expected, with the median above neutral for 2023 and 2024, Jeffries said in the note. The US Treasury yields jumped sharply following the Fed decision. The 2-year Treasury yield, which is sensitive to rate hikes, rose above 1.9%, pricing in the Fed's 7 rate hikes for this year. The broader market was initially spooked by the steeper than expected path of rate hikes, but it found its footings later and regained the momentum seen ahead of the Fed decision, following more positive news concerning the Ukraine-Russian war. The Financial Times reported that Ukraine and Russia have drawn up a neutrality plan to end the war. So the S&P 500 rose 2.2%, the Dow Jones Industrial Average gained 1.6%, and the Nasdaq rose 3.8%. Financials, mostly banks, which benefit from rising treasury yields, were the biggest gainers, up about 2%. Rising technology stocks also pushed the broader market higher, despite expectations for steeper interest rates, the enemy of growth stocks like tech. Energy was also in focus, weighed down by falling oil prices as investors digested positive Russia-Ukraine developments and the surprise build-up in US weekly crude stockpiles. US weekly oil inventories rose by 4.343 million barrels for the week ended May the 10th, which confounded expectations for a 1.3 million barrel decline. In other news, Chinese tech rose after Beijing said it would roll out support for the broader economy following a surge in COVID-19 cases, and suggesting that the crackdown on tech companies would soon come to an end. So, standing back, Ed Moyer from Honor summed it up pretty well. US stocks went on a roller coaster ride after a hawkish FOMC statement initially sent risk assets lower, but then turned positive after Fed Chair Jerome Powell tentatively convinced markets the central bank will not be too late with fighting inflation. Much of today went as expected, with the Fed raising rates by 25 basis points and addressing how the war in Ukraine is driving additional inflationary pressures. The dot plots show the Fed is expecting to raise rates at every meeting going forward, and the Fed said it will also begin reducing its asset holdings at a coming meeting. The Fed has positioned itself to aggressively tackle inflation, with half-point increases on the table and a potential balance sheet runoff that could start as early as May. Powell remains confident with the economic outlook and that it can handle tighter monetary policy. But he won't commit to taking more action now to tackle inflation, but that will probably become more likely at the next meeting. Powell's press conference got interesting when he signaled the central bank could move more quickly and that a balance sheet reduction announcement could come as soon as May. It seems the Fed sneakily somehow managed to scramble to fight inflation, and that is potentially removing the risk of a policy mistake. The economy could still end up in a recession next year, but at least the Fed positioned itself a little better to fend off inflation. The February retail sales report showed the widespread pricing pressures are starting to weigh on consumers, but it also contained massive positive revisions for January. Retail sales for February increased 0.3% less than the 0.4% forecast, but the January reading was massively revised higher from 3.8% to 4.9%. The 2 months retail sales numbers suggest consumers are handling the current surge in prices, and that could last a little longer, as many households still are holding on to a lot of cash. Crude prices pared losses after a hawkish Fed showed that they were ready to tackle inflation. Oil is just too volatile, and today's FOMC meeting raises questions about long-term growth, which is bad news for the crude demand outlook. Questions about how much Russian oil output will continue to swing, and uncertainty on how bad crude demand destruction will get, will keep energy markets jittery. Earlier, oil was under pressure after the EIA crude inventory report showed stockpiles rose by 4.35 million barrels, a surprise from the expected draw of 1.3 million barrels. The surge in gasoline prices has not discouraged drivers as demand edged higher from the prior week. What was very interesting was that US production remained stuck at the 10.6 million level for a sixth straight week, even as rig counts have been steadily rising over the past several weeks. WTI crude should find support soon, but momentum selling has taken prices near some key technical levels. If the $94 level breaks, not much might get in the way until the $90 level. Elsewhere, gold prices initially tumbled on a hawkish Fed statement and the economic projections, but pared a good amount of their losses after Powell signaled the balance sheet runoff announcement could well start as early as May. Wall Street is now expecting 75 basis points in rate hikes over the next 2 meetings, and for a balance sheet runoff before the summer. Investors don't have to look hard to find a reason to go defensive and to buy gold. And monetary policy is getting restrictive, stagflation risks remain, and uncertainty over the war in Ukraine seems like it could persist for months. Bitcoin gave up earlier gains after a hawkish FOMC decision sent risky assets lower. Bitcoin was able to recapture the 40,000 level after Powell signaled monetary policy was going to get restrictive for the US economy, sending the dollar sharply lower. Bitcoin still remains stuck, though, in its 37,000 to 45,000 trading range, and that should remain the case over at least the short term. So you can see here all of the cross currents that are running in the markets at the moment and what the Fed is trying to do, but The two big questions for me are, firstly, has the Fed woken up sufficiently to really tackle inflation? And will rising interest rates help with the sort of inflation we've got? And secondly, that nagging question in the back of my mind is, where has the Fed put the Fed put? Because at some point, if markets really do plummet, well, that could change it all again. Uncertainty rules. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.